Welcome to the deep dive. The financial world is going through something pretty huge right now, a real shift. We're seeing the crypto market hitting, well, multi-trillion dollar valuations. It's massive. What used to feel like a niche experiment, it's becoming a real force.
Absolutely undeniable at this point.
So today, we're diving deep into global crypto finance, trends, technology, and future. Our mission for you is really to cut through all that noise. We want to pull out the key insights from, the latest research, market intel. We'll unpack how DeFi, decentralized finance, is growing up, how traditional finance isn't just watching anymore, it's jumping in. And crucially, what the future looks like as these two worlds collide.
It's complex, yeah.
And moving fast. But we're here to try and make sense of it for you, help you grasp what it all means.
It's a fascinating convergence, that's for sure.
Okay, so let's start there. This convergence of traditional finance, TradFi people call it, and crypto. For a long time, they felt like separate worlds, didn't they?
Completely different universes, almost.
But things like the Bitcoin spot ETF approval in the U.S. and now Ethereum ETFs too, that feels like more than just opening the door for money. It feels like it's changing the actual structure of the market.
Oh, definitely. It's not just the amount of capital flowing in, although that's huge. Think pension funds, hedge funds, banks. It fundamentally legitimizes it for a whole new class of investors who need that regulated, familiar format.
Right. But beyond just the money, does that subtly change, the power balance away from the native crypto exchanges maybe?
Well, that's what's really fascinating. The ETFs are a catalyst, yeah, but look deeper.
Yeah.
You've got massive players, BNY Mellon, JP Morgan. They aren't just buying crypto, they're building the pipes. When BNY Mellon offers crypto custody, that's not just a service, it's like a stamp of approval.
An institutional nod, yeah.
Exactly. It says this is a legitimate asset class for serious portfolios.
Yeah.
So it's a lot about taking power from native exchanges maybe, and more about integrating crypto into the core plumbing of global finance, which, yeah, forces those native platforms to adapt, maybe specialize more or integrate.
Okay, that makes sense. And if you've got all this big money, these big institutions coming in, regulation becomes the next big topic, right?
Immediately, it has to. And we're seeing this scramble globally to create rules. What's interesting is how different the approaches are.
Yeah, tell us about that. Because different approaches mean different risks, different levels of protection for investors.
Precisely. So take the EU's MiCA, the Markets in Crypto Assets framework. People talk about it being the first comprehensive framework, which it is. But what makes it really revolutionary is its approach. Take stablecoins, for example. MiCA learned from past blowups like Terra Luna and put in strict reserve requirements before another crisis could happen. It's proactive.
Trying to get ahead of the problem.
Exactly, rather than just reacting afterwards. And that foresight, that comprehensive nature is why it's becoming a kind of blueprint for other regions, even though regulating something this global and digital is incredibly complex.
And they contrast pretty sharply with the U.S., doesn't it? The SEC's approach seems more like regulation by enforcement.
It does. And look, that definitely pushes for transparency through lawsuits and settlements. It forces accountability. But the downside is huge uncertainty. If you're an innovator, you're trying to build something new.
You don't know if you're breaking a rule until they come after you.
Kind of. It's like trying to build a house when the zoning laws are unclear until you've laid the foundation. It can stifle innovation, or at least make companies very cautious.
Right. And then you see places like Singapore, Hong Kong, the UAE. They seem to be taking a different path again.
Totally different. They're actively competing. It's not just about being crypto-friendly. They're designing specific regulatory sandboxes, clear licensing paths. It's an aggressive strategy to pull in talent and investment.
So they're offering clarity even if the rules are still strict.
Exactly. A clear, albeit stringent path. This global competition in how you regulate is fascinating in itself. It pushes everyone to figure out how to foster innovation while still managing the very real risks.
Okay, so institutions are in, regulation is evolving. But let's get back to the core tech, the engine behind a lot of this. DeFi, decentralized finance. This whole ecosystem of lending, borrowing, trading on the blockchain without the usual banks or brokers.
Right. Cutting out the middleman using smart contracts. It promises efficiency, accessibility.
But what about measuring its health? We hear about TVL, total value locked. Is that the whole story?
It's a key metric, for sure. TVL shows how much crypto is committed to these DeFi protocols. It gives you a sense of activity, of confidence. But, for an informed look, it has limits. It doesn't always show how efficiently that capital is being used.
Okay.
And it can sometimes be inflated by double counting assets across different protocols, or it might not fully capture the riskiness of the underlying assets. So yeah, high TVL is good, shows activity, but it's just one indicator. You need to look deeper.
Got it. Now, something that sounds really game-changing is this trend of real-world asset tokenization, RWA.
Oh yeah, this is huge.
So we're talking about taking things like what, real estate, bonds,
Yeah.
commodities?
Exactly. Traditional, often illiquid assets. Think buildings, corporate debt, maybe even fine art or shares in private companies, and bringing them onto the blockchain as digital tokens.
So you could own like a tiny fraction of an office building
Yeah.
or a bond and trade it easily.
That's the vision. The promise is massive liquidity for things that are normally hard to sell quickly, and fractionalization, breaking expensive assets into smaller pieces so more people can invest, making the inaccessible accessible.
That sounds incredible. But what are the hurdles? It can't be that simple.
It's definitely not simple. The biggest hurdle is the legal and regulatory side. How do you ensure that token actually represents legal ownership of the real world thing? How is that enforced across borders? Bridging that gap between the digital token on the blockchain and the legal reality off-chain. That's the really hard part. That's where the deep work is happening now.
Makes sense. And speaking of tokens representing things, NFTs. They started as digital art mostly, but seem to be evolving too.
Absolutely. They've moved way beyond just speculative collectibles. Now you're seeing NFTs used as access passes for events or online communities, proof of ownership for digital items, even physical ones sometimes. The utility is really expanding.
So less about just the art, more about what the token does.
Exactly. It's becoming a foundational piece for what people call the creator economy. Think musicians selling NFTs that grant backstage access, or writers offering tokenized versions of their books with extra perks. It gives creators more direct control, a direct relationship with their audience, new ways to monetize.
Interesting. But are there challenges there too? Scaling, making it easy to use.
Oh, for sure. Scaling is always a challenge in blockchain. Ensuring these NFTs can work across different platforms, interoperability, and just educating people on the practical value, not just the get-rich-quick hype that surrounded the early days. The shift is definitely towards NFTs with real utility.
Okay, let's peek under the hood a bit. The tech driving all this. Ethereum is still king of the hill for smart contracts, right? It's the base layer for so much DeFi.
Unquestionably. It has the largest developer community, the most battle-tested infrastructure, but it's had growing pains. We've all heard about the high gas fees, the transaction costs, and how slow it can get when lots of people are using it.
Yeah, that can be frustrating.
Definitely. And that's where Layer 2 solutions have become so important. They're built on top of Ethereum to handle transactions more efficiently.
Like Arbitrum, Optimism, Polygon.
Yeah.
Those names you hear a lot.
Exactly. And they use different techniques. Some, like Optimism and Arbitrum, use optimistic rollups. Basically, they assume transactions are valid unless someone proves otherwise. Others are moving towards zero-knowledge rollups, or ZK rollups, which use complex math to prove transactions are valid without revealing all the data.
So they help Ethereum scale up, handle more traffic, lower the costs.
That's the goal. They make applications built on Ethereum much more usable, much cheaper. But it's important to realize they have different trade-offs. Security models, how easy they are for developers, how decentralized they are. It's not a one-size-fits-all solution.
And Ethereum isn't the only game in town anymore, right? We're seeing new blockchains pop up.
Yeah, absolutely. You've got Solana, Avalanche, newer ones like Sui and Aptos. They're often designed from the ground up for high speed and super low costs. They use different ways to agree on transactions, different programming languages. They're directly challenging Ethereum, especially for applications that need massive throughput like gaming or high-frequency trading.
So lots of innovation happening across the board. And you mentioned zero-knowledge proofs earlier with layer 2s. That sounds like really advanced stuff.
It is. Zero-knowledge proofs, or ZKPs, are fascinating. The core idea is pretty mind-bending. They let you prove that a statement is true without revealing the information that makes it true.
Okay, hang on. How does that work? Like an example.
Okay, imagine you need to prove you're over 18 to access a website. Normally, you'd show your ID, revealing your name, date of birth, address, lots of private data. With a ZKP, you could mathematically prove you meet the age requirement without revealing your actual birth date or any other info.
Wow. So huge for privacy.
Huge for privacy, yeah. But also for scaling, like we saw with ZK rollups, they can bundle tons of transactions together off-chain and create one tiny proof to put on the main blockchain, proving they're all valid. It's incredibly powerful tech for both privacy and efficiency. It could unlock a lot of new applications that need confidentiality.
Incredible stuff. But with all this potential, all this innovation, we have to talk about the risks. It's not all smooth sailing. We know about price swings, the volatility, that's obvious. But what else should people, especially institutions, really be watching out for? What's maybe less obvious?
That's a great question. Because yes, volatility is the big headline risk. It's driven by everything from Fed policy to just market vibes. And of course, big failures like FTX or Terra Luna really shake confidence. But a risk that's maybe underestimated, especially in DeFi, is smart contract
The
risk.
code itself.
Exactly. These DeFi applications run on automated code, smart contracts. If there's a bug, a flaw, an exploit in that code, hackers can drain funds, and it's often irreversible. It doesn't matter how great the market is doing if the code itself gets compromised.
So the tech itself can be the weak point.
It absolutely can be. It highlights why things like rigorous code audits are so critical, though even they aren't foolproof. And beyond that, you still have the constant threat of security issues like phishing scams where people get tricked into giving up their keys, or rug pulls projects that just disappear with everyone's money.
Right, the human element of scams.
Yeah. Then there's legal risk. We talked about regulation. The inconsistency globally makes it really tough for businesses operating across borders. What's legal here might be gray area there. And finally, preventing money laundering AML. Global bodies like FATF are pushing hard for stricter Flipport. Know your customer, KYC, and AML rules everywhere to stop crypto being used for illicit finance. It adds complexity for users and platforms.
It's definitely a space where you need to keep your eyes open. Okay, let's shift gears to the future, the exciting part. Looking ahead, say, to 2025 and beyond, what are the big predictions? Where is this all heading?
Well, I think we'll see that institutional adoption deepen significantly. It won't just be about holding Bitcoin or offering ETFs. Expect to see more institutions getting involved in crypto derivatives, using crypto as collateral for loans, maybe even using blockchain for things like settling international payments more efficiently.
So really embedding it into their operations.
Exactly. Moving beyond just investment into actual utility within the financial system, then there's the whole area of central bank digital currencies, CBDCs.
Ah, government's getting in on the Digital Currency Act.
Right. China's already piloting one, the EU is working on a digital euro, the US is exploring it. This creates a really interesting dynamic. On one hand, it's competition for existing cryptocurrencies, but on the other, it's a massive validation of the underlying blockchain technology by governments themselves. It could reshape payments globally.
Interesting tension there. What else?
DeFi will continue to evolve, call it DeFi 2.0. The protocols will likely become more sophisticated, hopefully more secure after learning some hard lessons. And a big focus will be on interoperability, making it seamless to move assets and data between different blockchains, breaking down those silos.
So you could use assets from Ethereum on Solana, for example.
That's the idea.
Hmm.
Better bridges between chains, better ways for them to talk to each other. And finally, one of the most potentially transformative trends is the convergence of AI and blockchain.
Okay, now that sounds futuristic. How would they work together?
Think about AI agents managing investments or running organizations decentrally on a blockchain, or using AI to analyze blockchain data for security threats or optimize network performance. It could create entirely new business models we can barely imagine right now. AI making decisions, blockchain recording them transparently and executing them automatically. It's a powerful combination.
Wow. Okay, so to wrap things up then, it feels like the big picture is this. Crypto has moved from the fringes, hasn't it? It's shown resilience, tons of innovation, and it's becoming, well, a really integral part of the future financial picture.
I think that's right. The key pillars are there. The institutions are not just interested, they're actively involved. Regulation, while complex, is becoming clearer in many places. And critically, the focus is shifting towards real-world applications, solving actual problems, not just speculation.
So for you listening, whether you're deep in this space already or just trying to understand it, the takeaway seems to be needing a solid grasp of the tech, staying on top of the legal side, being really rigorous about managing risk beyond just price, and just keeping a close eye on these global shifts. It's constantly evolving.
Constant vigilance is key. It rewards informed participation.
Definitely. Maybe here's a final thought for you to chew on as we finish. We talked about AI agents on blockchains, government digital currencies alongside Bitcoin and Ethereum. How might your personal relationship with money, with your assets, with your financial identity, how might that fundamentally change over the next, say, 10 years? What new opportunities might open up for you? And what new challenges might you need to navigate in this new landscape? Something to think about.